This is a really cool trade. There's all kinds of lessons in here. So what do you see this? So this is a stock symbol UE, and today's February 14th, 2020. So I saw this formation where there's a double head and shoulders. You almost never see this. In fact, I'm not sure I ever saw this, but there's a major head and shoulders. So this is the left shoulder, the head, and the right shoulder. And the yellow line, that's the neckline. And you drop a vertical from the head, and you copy that vertical and drop it from the neckline where the breakout is, which we haven't had yet, but I anticipate it's going to be about there. You drop that down, and the bottom is approximately where you would expect price to go once it breaks the neckline. Now look at this. Over here on the right, there's a second little mini-me head and shoulders. Where you got the head here, left shoulder, right shoulder. These are the armpits. And this white line is the neckline for this head and shoulders. So drop a vertical, same thing. I think it's going to break out about here. Drop that vertical. So this is about where you'd expect the price to go. So you got two head and shoulders with just about the same neckline. If price breaks through here, it's going to be amazing. It's going to be it should drop like a rock off a cliff. So I'm looking at this and I'm thinking, oh, this is fantastic. I got to get in on this on the short side. So what I wanted to do was get some puts. So I looked at the option chain, and I have it here to show you. Let me get the option chain. This guy. So the options are horrible on this stock. Look at the bid-ask spread. The bid is $8.20, and the ask is $10.30, and the stock is only an $18 stock. That's crazy. That's just absolutely crazy. The difference was like $2 spread, and this isn't any better. That's like a $2 spread. So this is a little bit better, but these are not good spreads. This one's not bad. That's not bad at all. But I would not want to get put options, and plus there's no volume. There's no liquidity. Look at the open interest. There's only two. There's 50, and there's 40. That's how many outstanding options there are on the call side. And today, the only sales were these two, and that was me, which I'll explain right now. So notice I got them for 10 cents, and there isn't even a bid on it, right? But normally, like I would just have to short this stock because I'm not going to use those options, right? So I'm going to short the stock. So I think, well, we have a 3-day weekend coming up. Monday is President's Day, and when you have a naked short on a stock, you just simply short the stock. You have an unlimited risk to the upside. Somebody comes along and announces that they're going to buy this company. The price could shoot up anywhere, and I have total exposure to that. That's not a good idea, right? So normally I would use a put spread to get in on this, or just puts, and my risk is limited to the cost of those options, but I can't use the options. So what I have to do is short the stock. And I thought, well, what am I going to do for protection when those horrible options? Well, what I did was I said, oh, well, wait a minute. Look, I can get a 20 strike call option for just 10 cents. It doesn't even matter what the bid-ask spread is. And I wouldn't sell these. I'm going to like if stock shoots up and I have to get out of this, I would exercise these options and turn them into stock anyway. So the bid-ask doesn't even matter. And so 10 cents times 100 shares, it's $10, right? So I thought, oh, that's what I'll do. I'll just get those call options to protect me. So I'm going to get in. I got in today at $18.58 short. I bought a couple hundred shares, or I shorted a couple hundred shares, and I have my strike price for the option is here. So my total risk I have down here. So I can always exercise that call option at the $20. So the most the stock will cost me to buy would be $20. So if I shorted it at 18.58 and I have a $20 call option, so I can buy the stock for $20, and I have 200 shares. So the difference, 20 minus 18.58 times 200 shares, is $284. That is my risk. Now, so I'll get back to the reward later. So I'm thinking, okay, so now I have a way to get in on this. Now let me take a closer look at the situation. Let me see where my exit would be so I know what my reward would be, and I could look at my risk-reward ratio. So I'm looking, and so let me go through this list. I wrote this list so we can look at this. So there's the double head and shoulders. Now, like I said, it hasn't broken the neckline yet. So if it does break the neckline, this would be great and very, very bearish. And by the way, if it doesn't break the neckline and starts to go up, that's actually a very bullish sign. A bearish setup that doesn't happen, doesn't come to fruition, is a very bullish sign. So if something happens, it misses this neckline, doesn't break it, and just starts shooting up, well, I've got that $20 call option, so that will increase. That will increase in value because it's not a call spread, it's just a call option. So this will continue to increase in value. So I'm kind of covered to the upside also, which is really cool. So okay, so if price breaks this, the smaller head and shoulders neckline, it's probably going to break this neckline too. So it's actually breaking two necklines at the same time, and this is just going to plummet. So that's the first part of the setup. The next part of this setup, when I was taught this, it was called a blue ice failure because the person that taught it, which is candlestickforums.com, Steve Bigelow, he uses the color blue for his 50 SMA. Well, I happen to use red, but I still call it the blue ice failure because that's what he called it. So this red line, that's the 50-day moving average. And what happened was, this is the blue ice failure setup. So you're above the 50, you come down under the 50, that's this red line, come down under the 50, you come back up, you try to get through where the red line is like the ice, you try to get through, you can't get through, so then you sink to the bottom and you drown. Very nice picture. So that's the blue ice failure. So that's the setup. You break through the 50, you come up, try to get back up through the ice, can't get through the ice, and you plummet back down. That's a very bearish setup right there. Plus, price is currently below every moving average that I use. So we're below the 50, we're below the 200, we're below the 8 EMA, we're below the 20 SMA. We're below every single moving average I have. So that's a bearish sign. Okay, so this is good Ichi. That stands for Ichimoku Kinko Hayo, which is a mouthful. That is a Japanese candlestick pattern from Japan, right? So I'll show you this. So this is a whole thing, right? So I won't get into every last detail, but this is called the cloud, and this is the price, and this is called the lagging line. So you bounced off the bottom of the cloud, and you're staying under that. You're underneath the KS line, you're underneath the TS line, you're underneath all these lines, and the lagging line just broke out through price. So you want this down below, you want to be below the cloud, you want to be below these other two lines, the red and the green, and that's true here, or below all that. Plus, I threw the 8 EMA on here, which isn't part of the Ichimoku cloud setup, but anyway, we're below that too. So the Ichimoku, which I check on stocks, just like as confirmation that it's a good setup, this is very friendly to a bearish situation. So we got that going for us. And let's see what else. Okay, not oversold. So the stochastics down here is just barely touching the 20 level. It's under 20, it's considered oversold. So we are not oversold. So we got room to run to the downside. So I shorted 200 shares at $18.58. I got these two March 20 calls at 10 cents each. So now let me tell you my targets. So for the little head and shoulders, the white lines, this white line ends here. So I put my target just a little bit above that, which is 1675. And the yellow head and shoulders projected target is down here. So, but I didn't put my actual financial target to hit down here because if you look over here, there's some previous support. So you see this swing low here and this swing low here. So I drew these horizontal white lines to represent that as possible support. So that comes over here. So I put my target just above those two levels of support at 1675. So what is my reward? Well, I got in for 1858 and I have one target at 1675. So you take that difference times 100 shares, and this is the other target. So I started with 1858, my target 1815. Take the difference times the other 100 shares. You add these two together and it's 526, which is roughly about 2 to 1. So my risk's 284, my reward's 526. That's roughly 2 to 1. That's a good risk reward. So I got that going. And I think that's it. But this is really cool. Double head and shoulders, and using 10-cent option to cover me in case the stock goes up so that I can short the stock. It's with options that are horrible, but I can actually use them. So because I'm going to exercise it if I need it, and it only costs me 10 cents. So everything kind of came together on the setup. Is looking really cool. So I'll put this in the blog, and I'll keep it updated. Okay. By the way, the blog. Let me see. I think I put it over here. This is the blog here, jmstweets.blogspot.com, and you can follow along with this. Okay. Well, thank you very much.